Hi everyone, Greg Martin, the Entrepreneur's Banker here, and I hope that you had a wonderful Thanksgiving dinner. I know that I had a wonderful time just being able to get off work a little bit, be able to reflect with friends and family, and to be able to say, hey, here's some things that I'm really thankful for. One of the things that I'm thankful for is you. And honestly, to be able to take this journey of a series where we're exploring and understanding how to sell your business and different aspects and different ways of looking at it has been so fun for me. But to have you alongside for the journey, I really do appreciate it. Well, I know that you're really going to enjoy this week's episode as we talk with AJ Taylor. AJ Taylor is a CPA with Thompson, Derrick, and Craig, a full-service CPA firm that's headquartered in College Station, Texas. And AJ and I have worked together with some clients, and one of the things that I love about AJ is that he is so knowledgeable about tax law and implications, but he's also a real strategic thinker to be able to think ahead to say, okay, well, here's some things that if we do it now may impact you, have some real meaningful impact and benefit you down the road. So I know that you will enjoy this conversation. If you're not connected with AJ, I hope that you do that right away. But take it away, AJ. Thanks so much for joining us.
Thank you for your willingness to share your wisdom. I think that a lot of entrepreneurs realize the importance of having what I call the Fab Five. That's those 5 advisors that surround and support an entrepreneur and push them towards success, however they define it. Mm-hmm. And their accountant had better be one of those.
Is it the number one?
It should be. Okay. Well, I think it varies. You know, it's good God in heaven, it shouldn't be their banker. But I think that most entrepreneurs do think that the accountant is a critical part of that team because there's nothing certain except for death and taxes. And having a good accountant that gives them good tax advice, not only through the operation of the business, gives them the dry powder and the financial strength to expand and to achieve their goals, but also minimizes the amount that they can legally pay to Uncle Sam. I mean, I want to live in a society that has roads, police, and military, sure, yeah. But I also don't want to pay 90% of what I make to the government. So having a teammate yes. Is really important, but specifically talking with entrepreneurs about selling their business, that's a huge liquidity event for a lot of entrepreneurs, and an event that has to set many of them up for the rest of their lives. So understanding the tax implications before you sell is super important. Mm-hmm. So how about you tell us a little bit about yourself and why it is that you love supporting entrepreneurs in general and specifically with this type of...
Sure. Well, thanks for having me. Glad to be here, first of all. So a little bit about myself. I graduated Texas A&M in 2010, did the PPA 5-year program, so I got my master's in 2011, and then went to work for a Big 4 company, Ernst & Young in San Antonio, okay. Where I got a broad range of experience there, individuals, partnerships, corporations, just kind of touched everything in the tax side. And then we found out we were pregnant with our first child and decided that we didn't want to stay in San Antonio. Love San Antonio, but it's pretty big, pretty big city. So College Station was home. My wife's family is from here, so we moved back here in 2013. So I've been with Thompson and Craig for 8 years. One thing I really enjoy about the smaller town feel here is you do get to work with small business owners, and you get to work with people that have realistic, this isn't a big company operation where, it's going to be fine. Like, this is make or break for a lot of these people. This is their livelihood. Yeah. And so we get to be, as you mentioned, part of the Fab Five. And I love doing that because you can see, when I was working on a big corporation at, a Big 4 firm, not that I wasn't making a difference, but I couldn't necessarily see that. And now in College Station, when I'm face to face with a business owner, I can tell I'm making a difference. That's one of the things I love, is just being able to walk through the process from beginning to end and being able to see, wow, we really had an impact here.
Mm-hmm. That's cool. So talking about entrepreneurs that are looking to sell their business, mm-hmm. when's the best time to bring their CPA, to bring that member in? Hopefully it's not, hey, this is what I did. Yeah. Now get me out of all the taxes I pay.
It's way harder to unwind something that's been done versus getting it done right in the first place. So to answer your question, I would say as soon as possible. If you're even considering, hey, I might want to do this. How does this work? I think it's just a good conversation to have with your CPA. Kind of lean on them for some experience. They probably have some knowledge with prior transactions that they've helped with other clients. And so it doesn't have to be anything formal, but just, hey, this is kind of what I'm thinking about. What are some things I should be thinking about and questions I should ask? And I think a CPA can really make a difference here at the beginning.
I think throughout this entire series, I've had a lot of conversations, and the first thing is kind of broken up into two different things. Mm-hmm. One, it talks about, what does the entrepreneur want? Mm-hmm. And then the second breakdown is the actual deal itself and the transaction. The number one thing that everyone has said, from people that have sold, people that have bought, people that have helped broker deals, is that you have to have good, clean, meaningful financials. And really to be able to, and that's where the CPA comes in, because a lot of entrepreneurs are busy running their business. They're not doing their own financials themselves. And it's not just throwing your tax documents in there, because your tax documents are accounted for in order to reduce your tax liability. But there's a lot of things, the owner's discretionary income and some other things that happen that have to be cleaned up and everything. And to be able to have your CPA that can have a little bit of time to actually work through that, and maybe have, dare I say it, 2 sets of books. It's like, here's the books that is tax compliant, but then here's very clearly what you can show a potential buyer, what this business actually does produce, because at the end of the day, a buyer wants to see a profitable business.
Right. We see a gambit of different styles of books and financials. Some of the books we get are super organized and detailed, and you can tell that a lot of thought has been put into it. It's being kept up. Sometimes we get a shoebox. There are no books, right? And so, no, certainly, Greg, that's a huge implication in trying to sell the business. You want to present a product to somebody and have that support with good, clean records, good, clean financials. And if you don't have that, certainly a CPA can help compile some financials and get that for you. But very important to have good, clean records before, you just want to be able to present that. This is why it's part of a good deal for you to buy my business. Look at the activity and what we've got on the book. So very, very important to have good, clean financials. Yeah.
So, and giving your accountant enough time to make sure to do that cleanup is critical.
We work well under deadlines, but we would like some time to make sure everything's clean. So absolutely, yes.
Okay, Jay, well, let's kind of transition a little bit into some more specific advice. And I realize that every sale is a little bit different.
Sure.
And every entrepreneur's situation is different. So I'm not asking for, okay, this is what you need to do every time. But
right.
Typically, I've seen and I've heard that most sales are asset sales versus stock sales. Mm-hmm. And we talked with Peyton Holt. You and I both know Peyton. Mm-hmm. And so he kind of gave us an understanding of what it's like from a legal perspective between those two.
Okay.
But from an accounting perspective, what is the difference between those two, and are they taxed differently?
Yes and yes. So we typically do see asset sales. Rarely is it a stock sale, and there's a couple different reasons for that. From the buyer side, if we're looking at the buyer side, I don't want to purchase stock necessarily, because when you purchase stock, essentially you're kind of stepping into the shoes of the transferor stockholder. So there's a risk there with what lawsuits, liabilities are outstanding, because if it's on the company and I'm the owner of the company now, too bad, right? And so that's just a risk you take with the stock sale. Another reason is, if I'm the buyer and I want to purchase, I'm going to throw a bunch of money into this business I'm purchasing, I want to be able to have some deductions and some write-offs for that. And so typically when I purchase stock, there's no depreciation or amortization I can take.
Okay. Because you're just buying the stock.
Because you're just buying the stock. It's like if you go out and buy Apple stock, right? Broad example, but there's no write-off. You have a basis in your investment, which is kind of what you have.
Okay, so what was basis? I'm a banker, so break it down for me.
My cost.
Okay.
I purchased Apple for $2,000. There's my basis.
Okay.
So I have a basis in my investment now of what I've paid for it, but I'm not getting an immediate write-off necessarily. Once again, it depends on entity structure, and there's lots of things. But in general, I'm just purchasing corporate stock. I only have basis, and there's not really a write-off there. Okay. Whereas on the other side, if I'm buying assets, now I have the option to Under current rules, there's accelerated depreciation. I have a new basis in those assets where I can start getting deductions for those, because you want to be able to deduct what you're paying for from the asset side.
Okay.
And I think that's why we see a lot of asset sales versus stock sales. It's most of the time the buyer's not really willing to, they want more of the value in the asset.
Okay.
So,
but then from the seller standpoint, so I'm selling it. Am I taxed differently if it's it's a stock sale versus an asset sale?
So same deal with our Apple example. If I just sell Apple stock to whoever on the market, I've got my gain, my cost of $2,000. I sold it for $3,000. Assuming I've held it for a year or longer, I've got long-term capital gains of $1,000. Same deal with stock in a corporation, like a closely held corp, C corp, S corp, whatever. I've got my basis, and I'm going to sell my stock or my shares. So I've got my capital gain, assuming I've held it for a year. Now, if I turn around and sell you assets, it's going to be different because I've probably depreciated some of those assets. And so there's a rule called recapture. So you're recapturing the depreciation you've taken on those assets. And the IRS says, hey, remember when we let you have the depreciation deductions against your ordinary income? Now we're going to make you pick it back up at your ordinary income rate. Okay. So you're not getting a capital gain on the portion that's recapture.
Okay.
And it's differences for buildings versus PP&E, machinery, equipment. There's different classes. But in general, you've got to recapture that. And then once you've recaptured the depreciation, any excess gain you have is going to be, once again, assuming a year or longer holding period, long-term capital gains rates, which are more favorable than ordinary rates under current tax law.
Okay. So really is having that conversation with your accountant ahead of time to know specifically within your world which one's better. And then also as you're going through and negotiating with the buyer, because it sounds like from the buyer's perspective, they very much want to have an asset sale versus a stock sale. Well, that may not be the most advantageous way for the seller.
Correct.
So having things put in place to be able to work through it and be able to plan for it. And if you're planning on selling 3-5 years from now, then what depreciation you take today might impact how much you actually take. Because realizing that if I've got a short-term gain today and I don't want to pay taxes today, but it's going to hurt me when I sell, just walking through some of those hypotheticals.
Yeah,
Gotcha.
Well, and there's planning opportunities, tax law changes. We've seen it, changed in 2018, big reform. Who knows what's going to happen with the current administration? So there's talk about that. So it's a timing thing, and you never know. Take a deduction today, it might be worth more the next year or so. So there's a lot of planning that goes into that too.
Well, one thing that I see very common is that entrepreneurs, they want to diversify their assets. So you've got an operating company, the thing that actually makes the widget or provides whatever the service is, and then a lot of entrepreneurs buy their own commercial property in order to build up that as an asset, and they're paying rent to themselves. And a lot of times, strategically, entrepreneurs will sell the operating company but retain the real estate. And I've talked to a bunch of we've got another episode that we talked to a bunch of bankers about having something that has less collateral value, AR and tongue depressors, versus having a building that has tangible collateral value and the difference of that. But from an accountant standpoint, what does an entrepreneur, a seller, need to think about if they're going to sell the business, retain the real estate, maybe go into some type of long-term lease?
Yeah, no, I think that's an absolute consideration, because you've got, if you sell the whole enchilada, including the building, if that was all your income stream, that's gone now. Whereas if you retain the real estate, as long as you can keep it rented, you've got a lease agreement, hey, here's some passive income coming in. So I think that's the main consideration from a tax perspective. If you're just selling the operating company, hey, all the proceeds I'm getting are allocated to this operating company. So how do we allocate among the various assets within the operating company? Versus if you sell both companies, now you've got to figure out, okay, what are we allocating to the real estate piece here? What are we allocating to the operations piece? Because we talked about recapture. it's going to make a big difference for both parties, buyer and seller, what's allocated over here in this bucket, real estate, what's allocated over here for operating, because the taxes are going to be different on those.
Because the depreciation that you've taken over X number of years
That's right.
is different.
That's right. Yeah. And so it's got to be an agreed upon, and typically you see that in the sales agreement. You'll see an agreed upon allocation of proceeds. Such and such for the building, such and such for the operations, and even within the operations, this much is PP&E, this much is, and so on.
Because I've seen a couple times where it's a little abnormal, but the real estate's actually owned by the operating company. And there's legal and tax ramifications why some people do that and some people don't. But I guess in that situation, it's very clearly defined. This $3 million sale, X for the building, X for the book of business, X for the equipment, Y for the AR.
Right.
And that has to be spelled out. And bringing someone like you in on the front side to be able to say, okay, here's what we're doing.
Right.
And then as the seller to be able to kind of know which is the most tax advantageous way to splice that all up. Because if you had $3 million for the building and $100,000 for the equipment, your tax is different than $3 million for the equipment and $100,000 for the building.
Absolutely, could be, yes. So yeah, and typically I'm trying to think if I've seen a situation where typically you've got a separate company owning the real estate, but no, in either event, certainly the allocation of proceeds is very important.
So what about ownership of company in both assets, an asset sale and a stock sale? Some entrepreneurs that I work with, they have a trust that maybe owns the equity of the business, owns the stock. Maybe, I've also seen partnerships where you've had each partner has a separate LLC that technically owned that, and then they owned the LLC. So having that layer of ownership, I understand, and Peyton, I'm not asking you to answer this, but Peyton could advise legally why you do that. You could talk about in day-to-day operations financially why you do that. But when you sell a business and you have to unwind multiple layers of business, does that impact tax at all, or is it all passes through to the warm bodied person that actually pays?
Yeah. In general, yes, it will work its way down to the end-all be-all individual or whoever it is, the group. But it certainly adds complexity to the unwinding. Maybe you've got different treatments. It just depends on how the structure is, right? With the holding company, and you've got an organizational chart that you've got to follow. So it can certainly add complexity. Trusts and individuals don't have the same tax brackets. Trusts are very much accelerated. They hit the highest tax bracket at a much lower level of income than individuals. So there's lots of factors in there, Greg. In general, yes, it all flows down, but certainly if you do have
flows down after Uncle Sam is different.
Yes. No, and that's where, like we talked about from the get-go, having the CPA looking at that structure and just advising, how is this all going to work through this flow through is very critical.
And then protecting yourself throughout operations, because I'm sure that it's not something that you can have it in a, I would assume the IRS would frown on you having all your ownership in a trust up until 30 days before you sold it, flipped it, and then went into a more tax advantageous structure right before you sold. I'm pretty sure that they're smart enough to figure that out.
There's a lot of creative accounting out there, a lot of creative things. So no, and this is where your CPA, who's familiar with the situation, hopefully can advise and make sure everything's clean and above ground.
That's right.
Yeah.
What about the actual transaction itself? And does it? I've got kind of a two-part question. Does it matter from a tax standpoint if it's all cash, maybe cash and some ownership in the new entity? A lump of cash, and then a seller note. I mean, how are all of those differently looked at? And what, just some general thoughts about that?
Yes, no, and it's absolutely different. It depends on when you get the cash, is the general answer. So if I sell my company and it's seller financed, typically I'm not recognizing any gain until I receive money. It's an installment sale, right? Okay. And so, no, there are certainly implications. If I get all the cash up front, yes, everything is in year one, we're done, move on. But certainly if there's any sort of outstanding, installment note, cash portion versus seller finance sum, there are definitely implications, especially when you're talking about an asset sale to the seller, because even if you get no money in year one, a very, very critical piece is that recapture we talked about.
Yeah.
If I sold you my assets this year, but you didn't pay me anything,
But I still sold you the assets.
Yeah,
The transactions happened.
Yeah, so I sell you the assets. The transaction has happened. I am free and clear of the assets. That recapture piece immediately picked up in year one, even if I didn't get any cash. So it's super important to make sure that you understand before you just sell or finance something. There are implications to that, to where, especially on an asset sale, you've got to be careful with that. So that's why you'll see a lot of times to avoid that very issue, you've got to have something up front, right? And a lot of people, I would say it's mostly cash up front, but there's certainly, you've got additional interest income on that note going forward if you finance some of it, which is fine. You're getting the cash, but that's just extra tax that you're going to have to pick up. So certainly different implications on when and how much you receive in any given year.
Gotcha. So really kind of working through that. But is what I heard also was that there could be some considerations or some tax planning that if you receive X amount in one year and then on January 2nd the following year, so those are two completely separate tax years. So based upon the income that you have, based on what tax brackets you have, just kind of having that forward plan and to be able to kind of think through and walk through how that sale actually happens. I think that could be a good tax strategy, assuming that the buyer, the seller, and if any type of financing is involved, the financing portion of it is also in aligned with that.
Yeah, assuming buyer and seller are comfortable with how the payments are being made and the frequency. No, there's certainly planning opportunities. From the seller standpoint, hey, I want to make sure I'm getting these payments frequently and on time. But certainly there's some opportunity, especially if maybe possibly big tax reforms coming on board or something like that. There's certainly opportunity there.
Gotcha. So I understand that I don't think that you've sold a business.
I'm
not yet you personally,
not.
but you've advised a lot of entrepreneurs kind of through the sales process. So in talking with those entrepreneurs, what has been the thing that they've kind of shared with you that's been the most difficult thing or something that they didn't expect?
Yeah, so no, that's a great question. And I would say the newness of it all. That's what I hear. Because, initially, especially if, you're thinking about buying some sort of practice or whatever it is, professional services or assets, you've typically got to have a company set up. You've got your attorneys involved. So you've got a new company. How are we going to tax that? What's the structure? You're meeting all these new people, bankers, CPAs, attorneys, hopefully, hopefully you're meeting for Fab Five. But for a lot of these people, it's all so new. They haven't had that in the past. And so I would say just the newness of everything, they feel overwhelmed because, and it's our job to make sure, hey, this is remember why you wanted to do this deal. You're still going to have money for groceries. Everything's going to be okay. Just continue to do what you do. But it can be overwhelming at times because I've got new entities, new cost. I've got a big loan I've got to pay now. So just the newness of everything I think is overwhelming at first. But really that's where we can be of great value to our clients, is just reassuring them along the path. We've got you. You're taken care of. We're doing the best we can for you.
But what about on the flip side? What about on the seller side? What has been really challenging for them as you've walked clients through shutting down and maybe walking away from something that they put 25 years into?
Right. When they get to the point of actually selling, that's always the hard part really, is like, can I sell my baby that I've grown, right? Yeah. But, after the fact, it's, well, what do I do now? I'm so used to the stream of income that I've had from the company, and now that's gone. And yes, I have a chunk of cash now that I need to do something with, but how do I manage that? How do I make sure that I can meet my goals? And that's where certainly advisors, CPAs come into play, because for a lot of people, it's kind of a deer in the headlights, right? I'm used to having this stream and now I don't. So how can we set this up to where I'm comfortable with this stream of income and I can live in, the way I want to, essentially.
And I understand how much if this is what I'm going to bring every year, how much Uncle Sam's going to take going forward, because I'm not running a business anymore. I don't have the depreciation schedule that I did before.
Tax
to be able
to
be able to give confidence to entrepreneurs that after you sell this, you're going to be okay for X number of years. Again, that's where you bring in their financial planner,
Right.
and whether that be investments, and then you start talking about, okay, well, how are you making money on those investments, and then what are the tax implications of that?
Right.
Because at the end of the day, if you are going to day trade, and that's how you're going to make your money, that's going to be taxed versus putting it in a long-term investment and holding on to that. So
That's right.
that having you as that part of the discussion before the sale, during the sale, after the sale is super critical.
Yes, yes. No, we want to be involved in every step of the way, because it is, you don't want to just, we're done, transaction's done. You want to carry out that and that's really where, you can show, hey, we brought a lot of value during this transaction. We want to continue that in this process now that you're in a new phase of life. And so that's really an enjoyable part for me, is that afterward where it's, the sigh of relief, It's all done. Now what do we do going forward with your new phase of life? So.
Okay, AJ, so you have shared a lot of wisdom and been very transparent with, hey, here's some things that you need to think about, things that I didn't even, that weren't even on my radar. And I've been not only doing the series, but working with entrepreneurs a lot. What's one bit of advice that you would give someone who's looking to sell their business in, let's say, the next 5 to 10 years? And what's one bit of advice you would give someone who's looking to buy the business
Sure.
in the next 5 to 10 years?
The best general advice for both of those questions is make sure your CPA is involved from the get-go. Like we talked about from the top, Greg, it is really difficult if a transaction is made, something's done, and the CPA comes in after the fact. It's very difficult to unwind that or make it to where it could have been more advantageous had there been planning on the front end. So get your CPA involved on the front end, certainly the Fab Five. I just think it's going to make life in a transaction process so much easier and cleaner. At the end of the day, like you mentioned, you don't want to pay 90% of your, to Uncle Sam, and we want to do everything we can to help with that. And part of that is just good planning and upfront discussions.
Well, AJ, thank you again so much for being here and sharing a lot of wisdom, things that I hadn't even thought about. You're kind of bring up, and I hope that entrepreneurs get a lot of value out of this. And they realize that having a CPA as part of your team is critical. Before we kind of get your contact information, I just want to make sure that everybody knows and is very clear that the opinions and what we've discussed today are AJ's and my views and our personal opinions only. They do not represent the companies that we work for or any affiliates or anything like that. So now that Peyton's happy and all our lawyers are happy that we're covered, AJ, how can entrepreneurs, if they've got more questions, get in touch with you?
Sure, yeah. The best way would be to go to our website, Thompson, Derrick, and Craig, tdccpa.com. My information is on there. We've got a great team on there, but certainly go to the website and you'll find our contact information there. And so it's been a pleasure. Thank you for having me on today.
Definitely. Yeah. And thank you so much for joining us. We appreciate the time that you've invested in us and the time that you've invested in yourself. And we hope that you enjoy this series. Until next time.
Did I tell you or what? A real strategic thinker. I love that AJ is passionate about helping entrepreneurs and really so open-handed with his experience and his knowledge. The top 3 things that I took away from our conversation with AJ was, 1, it's easier to plan for your exit than it is to unwind some of the things that may happen. So to be able to engage your CPA partner early in the process to help you understand what the tax ramifications are is super, super critical, because being able to put some things in place may have some really strategic benefits for you down the line. The number 2 one is very, very similar to that, in that while there are a lot of strategic ways that you can understand how to protect yourself and maybe shield yourself from the tax liability, you need time in order to actually implement those. So coming to your CPA when they're 7 days out from selling your business is probably not a good idea. But engaging them early in the process and understanding the difference from a tax perspective, the difference between a stock sale or an asset sale, and what's best for you is really super critical, because by engaging them early and having that time in place, time to be able to put some things in place, it may help you and pay huge dividends. And then 3, the final one, is that you have to be able to know your number. And this is kind of reflecting, obviously I talked about that with Corey way back in our very first conversation. But what I found really interesting is that you need to know your number not before tax. You need to know your number after tax, after the sale, and then understand the tax implications and how that affects your number going forward, whether that be the having a seller note or taking all the money all at one time, and then what are you going to do with it? If you're going to invest it, well, that's going to generate income that might be taxed at a different bracket or in a different way. But knowing and understanding the tax implications of your number is super, super, super critical. Well, again, if you have not connected with AJ, I hope that you do yourself a favor, that you reach out to him, connect with him on LinkedIn or send him an email, go to the Thompson, Derrick, and Craig website and reach out to AJ and let him know how much you appreciated him and the wisdom that he shared with us. I hope that you join us next week as we continue the series with Stephen Sutton. Stephen is a great friend of mine, and when I started thinking about who I wanted to interview for this series, he was number one on the list because Stephen just sold his business. Earlier in the year, Stephen actually went through the transaction of selling his business to a partner. And so to be able to understand, while it's really fresh on his mind, what it was really like to be a seller of the business is going to be so much fun. And I know that you will enjoy our conversations that we have with Stephen. If you and I are connected on LinkedIn or Facebook, I hope that we do that. I really pray that this has brought a lot of value to you and allowed you to kind of think about exiting your business from a different perspective. If you have any questions or concerns, I'd love to be able to connect and help any way that I can. And I hope that you join us next week when we talk with Stephen and continue to explore selling your business 360, a full circle view of your exit. Until then, this is Greg Martin, the Entrepreneur's Banker, wishing you happy running as you're taking off all those pounds from turkey.